Welcome to The Deep Dive. We're the show that cuts through all the noise of corporate earnings calls to bring you the really critical nuggets of knowledge you need.
That's right. We filter out the fluff so you get straight to the insights.
And today we are taking a comprehensive deep dive into TE Connectivity's third quarter fiscal year 2025 earnings call.
And right from the get-go, it was pretty clear this was a quarter that delivered some, truly remarkable results.
Yeah, it really demonstrated the power of their strategic long-term plays. So our mission for you today is simple. Distill those key financial highlights, unpack the strategic thinking behind them, and clarify the future guidance.
Basically, so you can quickly grasp what's truly driving TE's performance and, what it means for their outlook.
Okay, let's start with the headline numbers then, because TE Connectivity, they really did outperform expectations in Q3, big time.
They certainly did. We saw double-digit increases pretty much across the board. They didn't just meet their guidance, they actually exceeded it.
Yeah, significantly. We're talking about, a 14% increase in sales?
14% sales growth, yeah. And an even more robust 19% jump in adjusted earnings per share.
Both hitting new quarterly records for the company. That's quite something.
It is. And what's particularly compelling, I think, about these numbers is that they aren't just, a lucky break or some kind of one-off anomaly.
Right. This feels earned.
Exactly. This performance, it's a clear payoff from years of really careful strategic positioning and, frankly, significant long-term investments.
And you see that in the margins too, right? Record adjusted operating margins hitting 20%.
20%, yeah. And alongside that, a record $1 billion in free cash flow generation just for the quarter.
Wow, $1 billion.
Yeah. That kind of consistency, especially in margin expansion and cash generation, it really signals a deeply robust underlying operational strength, sets them apart.
Okay, so let's unpack this a bit further then. Let's dive into the specifics because the real story here, like you said, is in the details of how they achieve these results. And maybe more importantly, where that impressive growth is truly coming from.
Agreed. Let's get into the weeds.
So the Q3 financials in more detail. Sales came in at $4.5 billion.
Which, as you said, 14% reported growth year over year, but also a very strong 9% organic growth. That's stripping out acquisitions and currency effects.
Good point. And adjusted earnings per share hit $2.27. That's that substantial 19% increase from the prior year. And that record adjusted operating margin, it expanded by 60 basis points. That's 0.6 percentage points year over year to reach that impressive 20% mark.
And what's especially noteworthy there is that both the transportation and the industrial segments are now basically running at those 20% margins. That's pretty balanced strength.
Yeah, it is. And looking ahead, orders also saw significant improvement. They hit $4.5 billion.
Right. That's an 8% increase year over year and 5% sequentially from Q2. Gives them a really solid foundation for their Q4 outlook.
Okay, so the big question then. What truly fueled this impressive operational performance, especially that margin expansion we keep talking about?
Well, the management team, they pointed directly to the industrial segment. That's where the adjusted operating margins expanded by nearly 400 basis points year over year. 4 percentage points.
400 basis points. Wow. How?
Well, it wasn't by accident. This comes from years of deliberate footprint consolidation and really focusing on reducing fixed costs.
So streamlining their factories and operations.
Exactly. Systematically streamlining their manufacturing and operational presence, cutting unnecessary overhead.
Yeah.
So now with higher volumes flowing through these, more efficient operations, they're experiencing significant operating leverage.
Meaning more profit drops to the bottom line for each extra dollar of sales?
Precisely. It turns every additional dollar of revenue into a much larger chunk of profit. It's a classic case of, long-term planning meeting current demand.
Okay, and this is where it gets particularly fascinating, right? The industrial segment itself.
Absolutely. This part of the business really accelerated. It delivered over 20% organic growth in the quarter.
And that wasn't just one thing, it was broad-based.
Very broad-based, yeah. Primarily driven by their digital data networks and their energy businesses.
Right. And the AI story within digital data networks, that sounds like a massive highlight.
Oh, it's huge. TE Connectivity's revenue from artificial intelligence applications is now expected to exceed $800 million this fiscal year.
$800 million. Wasn't it like $300 million last year?
Exactly. It was $300 million just last year. So that's a huge leap. And management even indicated they anticipate a run rate, looking forward, of above $1 billion for next fiscal year.
$1 billion run rate in AI-related revenue. That's an exponential curve.
It really is. And if you connect this to the bigger picture, management strongly believes they are still just in the middle to early innings of the whole AI opportunity.
So lots more room to grow there.
They certainly think so. And this isn't just about supplying, generic components. It's about TE's specific proprietary connector technology. It enables faster data transfer, more efficient power delivery right at those critical interconnect points within AI server clusters.
Which is often a bottleneck, right?
A huge bottleneck, yeah. It's something many competitors are still struggling to address effectively, and it gives TE a distinct advantage. Plus, this AI segment also delivers margins that are, in their words, a little bit above the overall industrial segment average.
So it's good for growth and profitability.
Right. And their strategy seems pretty comprehensive, too. They're playing across the entire AI ecosystem, working with the major chip makers, the massive cloud data center operators, the hyperscalers like Amazon, Microsoft, Google.
And the contract manufacturers who actually build the systems.
Exactly. They're embedded kind of end-to-end in that whole value chain.
Okay, so beyond that AI surge, their energy business also saw remarkable growth, something like 70% sales growth.
70% reported sales growth, yeah. Now, that includes the impact of the recent Richards acquisition they made.
Ah, okay.
But even organically, if you strip out acquisitions, the energy business grew a very strong 20%. Still very impressive.
So what's driving that organic energy growth?
Well, this surge, especially strong in North America, is really being driven by significant growth opportunities in the utility market.
Utilities, like the power grid.
Precisely. We're talking specifically about grid hardening.
Yeah.
Making our electrical grids more resilient to extreme weather, higher demand, and also the ongoing build out of renewable energy applications, solar, wind, etc.
And the Richards acquisition fits in there.
Yeah, Richards is heavily aligned to grid hardening right now, but management sees clear future potential for its products in those critical renewable energy applications down the line as well. So it's kind of a dual tailwind for them.
Makes sense. Okay, what else stood out in industrial?
Well, we also saw solid performance in automation and connected living. That grew 5% organically.
And that's showing encouraging signs of recovery in factory automation.
Exactly. Which, while it's smaller, it's critical because it can signal a broader industrial recovery beyond just the AI hype. TE's connectivity solutions are pretty foundational for things like smart manufacturing, industrial IoT.
Got it. And aerospace and defense.
That grew a healthy 6% organically, benefiting from, pretty favorable demand trends and also improving supply chains in that sector, which had been a headwind before.
Okay. So industrial looking very strong overall. Now let's shift gears a bit to the transportation segment. You said the picture there is a bit more nuanced.
Yeah, a little bit mixed, you could say. The auto business, for instance, grew 2% organically in Q3, which sounds okay, but that overall growth number was heavily influenced by pretty significant regional disparities. They saw robust 11% growth over in Asia.
Okay.
But that was largely offset by a 5% decline in Western regions, so Europe and North America.
Ah, okay. So strong East, weaker West, and auto. What about commercial transportation, trucks and the like?
That saw 3% organic growth. And importantly, the orders there improved both year over year and sequentially. That suggests maybe some traction as that cycle begins to turn upwards again.
That's positive. Any other weak spots in transport?
Well, the sensor business, which cuts across some of these areas, did experience some specific weakness in those Western end markets as well, mirroring the auto trend.
Right. So this really highlights the unevenness we're seeing in the global auto market right now, doesn't it?
It really does. And it's interesting because while global auto production overall was actually slightly down during the quarter,
TE managed to outperform it even with that Western weakness.
Exactly. They still managed positive organic growth overall. Which raises an important question. How are they doing this?
Yeah, what's the key?
Well, their strong position in Asia, which now accounts for about half of their total automotive revenue.
Yeah.
It's a big factor. Plus their localization strategy.
Meaning they build where they sell.
Pretty much, yeah. Build close to the customer. It's proving to be a key differentiator. It's helping them effectively mitigate some of that softness in the Western markets where, we're seeing EV pushbacks and maybe broader economic slowdowns having a more pronounced impact.
So it shows a certain resilience in a pretty challenging environment for auto suppliers.
Definitely resilience.
Okay, so what does this strong Q3 performance, balancing act and all, what does it mean for the road ahead? What's the guidance look like?
Well, TE Connectivity's fourth quarter guidance implies continued robust performance, Pretty solid outlook.
Okay, what are the numbers?
They expect Q4 sales to reach $4.55 billion.
Just slightly up from Q3 then.
Slightly up sequentially, yeah. And that represents 12% reported growth and about 6% organic growth year over year. So still healthy growth.
And earnings.
Adjusted EPS is projected to be around $2.27 as well. Same as Q3, which would be a solid 16% increase year over year.
Okay, so holding steady on EPS despite maybe slightly slower organic growth than Q3.
Right. And if you connect this Q4 guidance to the bigger picture, it really points to a strong performance for the full fiscal year 2025. We're looking at high single-digit sales growth overall for the year and double-digit adjusted EPS growth.
Pretty impressive results for the full year then.
Very much so. And the company also expects to deliver another year of free cash flow conversion well above 100%.
Meaning they convert more than their net income into free cash.
Exactly, which just reinforces their impressive financial strength and, importantly, their flexibility.
And that robust cash generation, that healthy balance sheet, it provides significant optionality for capital allocation, right? That's a powerful position to be in.
Oh, absolutely. And they've been using it. The company returned, $1.5 billion to shareholders this year through dividends and buybacks.
Okay.
And they also deployed $2.6 billion for acquisitions this year.
Mostly in industrial.
Yeah, largely strategic deals, strengthening that industrial segment and helping them capitalize further on those powerful secular growth trends we've been talking about, AI, energy, automation.
And what did they say about the M&A pipeline going forward? Still active.
Yeah, management described it as good, particularly for those bolt-on acquisitions, smaller deals, especially in the fragmented industrial landscape where they can add specific technologies or market access.
And they have this target for how profitable those deals and their organic growth should be, right? Something about flow-through.
That's right. They aim for an impressive incremental flow-through on organic revenue growth of 30% or better for their businesses.
Which is a key driver for that ongoing margin expansion we discussed earlier.
Absolutely. It essentially means a significant portion, nearly a third, of every new dollar of organic revenue is converting straight into operating profit. It's a high bar, but key to their model.
And they also confirmed that the strategic investments, like in R&D and building out manufacturing capacity, especially for AI, that's baked into their plans.
Yeah, they made that clear, particularly for AI, where capital expenditure, CapEx, is up around 30% this year. They said those investments are largely embedded in their current run rate.
So they're investing heavily, but it's planned for.
Right. And they view these investments as absolutely essential for them to keep pace with the accelerating demand in these really high growth areas. You have to spend to grow.
Makes sense. Did they address any concerns about, say, demand suddenly falling off or maybe risks from tariffs?
They did. Management stated pretty clearly they see no meaningful impact from customers, like pre-buying inventory just because of tariff fears.
Okay. So demand seems real.
Seems that way. And they confirmed tariffs had only a minimal earnings impact in Q3, largely thanks to effective mitigation strategies they put in place over time, things like localizing supply chains.
So they feel confident about the durability of demand.
They do. They emphasize it's clearly driven by these long-term secular trends, the global growth of electricity usage, the continued expansion of AI. Yeah, that gives them genuine confidence in their outlook, despite some of the macro noise.
Got it. And for our listeners keen to hear more directly from the company.
Yeah, they announced an investor day. It's going to be in Philadelphia on November 20th. So mark your calendars if you follow TE closely.
Good to know. Okay, well, this is the deep dive. And now it's time for our, this is not financial advice, this segment. This is where we pitch an outrageous but maybe plausible trade idea based on today's call.
Always my favorite part. Let's hear it.
All right. So consider this. A long position in TE connectivity, ticker TEL, but strategically hedged.
Okay, hedged with what?
Hedged by a short position against a basket of, let's say, traditional legacy automotive component suppliers, particularly those with really high exposure to those weaker Western markets we discussed.
Interesting. So long TE, short, old school auto parts guys focused on the West. What's the core thesis?
The core thesis is basically this. TE's accelerating momentum in these high-growth, high-margin sectors like AI, like grid hardening, evidenced by AI revenues surging towards potentially $1 billion next year, industrial margins crossing 20%.
Right.
That momentum will not only fully absorb, but actually dramatically outperform any ongoing softness or regional challenges they face in the global automotive sector, especially compared to those peers stuck mainly in the declining Western auto markets.
So it's not just about diversification for TE, it's a bet on their strategic positioning winning out.
Exactly. It's a bet on their strategic positioning and their proven operational excellence in the most critical growth areas of the future, while others might be struggling with, legacy market headwinds and slower transitions. It's basically a play on the future of industrial tech versus maybe the past.
Outrageous but plausible indeed. A pair trade based on divergence. I like it. Again, not financial advice, folks.
It's definitely not financial advice. Okay, so let's wrap up our deep dive into TE Connectivity's Q3 FY25 earnings call.
Yeah, I think it's abundantly clear the company delivered, a really standout performance.
Agreed. They hit record highs in key financial metrics, sales, EPS, margins, cash flow, and powerfully showcase the returns they're getting on those strategic investments in high growth areas like AI and energy infrastructure.
And their robust execution, that healthy balance sheet we talked about, and a clear vision for continued growth and smart capital deployment. It really positions them strongly, I think, for ongoing earnings expansion and sustained value creation.
Yeah, the insights from this call really highlight the critical importance of adaptability and strategic foresight in navigating what is still a very dynamic global market.
Absolutely. Being in the right places with the right technology and executing well.
So here's maybe a final thought for you to mull over. How might TE Connectivity's increasingly diversified portfolio, combined with that astute localization strategy they employ, how might that fundamentally reshape the long-term competitive landscape for other big diversified industrial technology companies?
That's a great question. Are they setting a new benchmark? Something to definitely think about.
Indeed. And as always, the information shared here on the deep dive is for informational purposes only. It should definitely not be considered financial advice.
Please do your own due diligence and always consult with a qualified financial professional before making any investment decisions.
We really hope this deep dive has provided you with some valuable and maybe actionable insights into TE Connectivity. Join us next time for another essential earnings call summary.